Welcome to the Ties Are Off podcast. We're back as promised on our first video and sound podcast. I'm here with Tom, Dav and myself. We're looking forward to talking more on the property and mortgage industry. It's been a very busy Christmas, as we can tell. And Dav, do you want to tell us more about your Christmas?
Chaotic.
Yeah.
Always in
my
my
bet was knowing you.
Great fun. Really nice to spend some time with the family.
Yeah.
But I gotta be honest, it's so good to get back to a bit of routine as well.
Yeah.
And four kids running around, yeah. I'm
running around to a certain degree, yeah.
Yeah. In case you didn't know, Dad does have 4 children, so busier household than mine, put it that way. 1 big dog versus 4 kids. So what about you, Tom?
Yeah, I had a great time, to be fair. This is actually my first beer of 2023, probably since the Christmas period, and I drank a little bit too much and caught the dreaded lurg, as did most people, I think. And yeah, feeling a bit better now, thankfully, and enjoying this beer. So, yeah. Thank you.
As we all are. So we did promise at the end of the last podcast that we would do multiple sort of structures and, structures that would work for you. So what we've done, we start with a quiz, and Dav's going to hit us off with the first question.
Yeah, so between week 1 in 2022 and week 1 in 2023, which year had the higher number of sales agreed?
And you?
Yeah, number 2, to the nearest £10 million, what price was the most expensive house listed in 2022?
Oof.
And 3 for myself is, what is an offset mortgage? And number 4 is, what is loan to value? So in the mortgage industry, loan to value is quite a common term. What is loan to value? And I think we got a surprise one at number 5, is it?
Yeah, a bit more of an out there one, I guess. So the Japanese government is to offer families how much to relocate from Tokyo to less densely populated areas. And there's a choice with this one. So is it A, 200,000 yen, B, 500,000 yen, C, 1 million yen, or D, 2 million yen?
I don't know the answer myself, so I'm looking forward to that. So apart from that, we're going to have the remaining structure of a bit more about Dav, a bit more about Tom, and have a bit more about me. Yeah, I have worked in mortgages for about 3 or 4 years. I've been in the mortgage industry for about, well, you could say 8 years if you include the insurance part of that. So a lot of the mortgages I tend to do are your day-to-day residential mortgages. Yeah, so residential homes, a lot of the homes where your day-to-day first-time buyers, people who are looking to buy a house after owning another house. But there's a lot of other cases which we deal with, not just me, but the people within our industry. The common things that a lot of mortgage advisors deal with are buy-to-lets. You're talking about remortgaging, further advances, or things where they're looking to borrow against their home. These are the sort of mortgages we deal with, and a lot of brokers I know who may be listening. It's a lot of the sort of day-to-day mortgage cases that we all deal with. So
sounds interesting, Ant.
Yeah, it is.
Are you finished?
Very interesting, and I'm done now.
Thank you.
That's got to stay.
Thank God for that.
So 2023 it's definitely going to be a different market. It's going to be an exciting one, but there's definitely a market recalibration in place for the entirety of the UK. It will differ. The stats will differ per region and per country, of course, but price moderation and a slowdown in sales are definitely likely over the coming months. But you've got to take a lot into context in that regard. The post-pandemic market, economic history, and the longer-term outlook as well. It's definitely less dramatic than during the 1989-93 and the global financial crisis as well in 07.
Yeah, well, that was obviously caused by banks lending more than the borrowers could afford to pay. So now, because of that, since 2014, they've given us basically, and Andrew knows this more than anyone else, and he might touch on it. It's more stringent lending criteria. So people today, they actually have more equity in their homes, so there's a bit more of a barrier to actually, if your home drops value, people won't be in negative equity as much. I think it's estimated that 4.2% of homeowners only have less than 10% equity in their home. So Yeah, it doesn't look like it's going to be like that. We're not looking at a crash as such, but we'll touch on that a bit later. And it looks like, thankfully, inflation did peak towards the end of last year. And I think that's going to fall back over the course of the year.
Yeah.
And unemployment is looking like it's remaining low as well, which all bodes well for property prices. So that's why we're not sort of worried like we were for a crash like 2007.
Yeah. And you know what, you say that, so we got a couple of interesting things here. So since June 2020, the average property price, they've risen to close to, as an average now this is, close to £50,000.
That is absolutely mental. What sort of percentage are we talking about per house then?
Percentage-wise, that is approximately, what, 24%? 24% rise? With lockdown and lifestyle changes spurring the market, of course, but that's a mammoth increase.
Crazy. We talk about that now. When sort of lockdown was announced, that nobody expected that at all. So it has been. We've got to take everything into context, like Dav said at the start, because it's been an absolutely mental 2 years.
It's been bonkers. You know, there will be correction. The correction is predicted over the next couple of years, but
yeah, don't forget we got the stamp duty changes. They're here until March 2025. So that's something that will keep the market buoyant and make it not slow down as much as like it would a crash. And we got to remember, the government doesn't want the property market to crash. This is why they bring these types of things in, like the stamp duty change. They want the market to remain buoyant. So it is slowing down, but only because we've had a crazy couple of years.
Definitely.
And we're always going to have buyers and sellers. Almost 1 in 3 movers move on a needs basis, and these buyers are going to present sales opportunities. But a big, massive but, realistic pricing is absolutely paramount to achieve the sale. So if you are looking to sell, it has to be a realistic price. So if you speak to an agent, and Dav, I know you'll say the same, if you speak to an agent and the price sounds too good to be true, it probably is too good to be true.
Yeah, and it's the pricing to entice this year, as Thomas just said, he's bang on the money on that front, hit the nail on the head. You've got to price your house right to sell in our current marketplace and get the most out of it as well. But as we've both said, and we'll both agree, 2023 is going to be a very different housing market. It might be difficult in some cases, but there will always be buyers who will need to buy, and there'll always be sellers who will need to sell. So overall, in the longer term, there's still a positive way forward, and we can look forward to the year to come, I think.
Yeah, definitely. It's going to offer a better opportunity for the people who are looking to buy this year, and also people who are selling who didn't want to sell in that crazy market. So yeah, we're coming back to a bit of normalisation, which a lot of people will prefer. You may have seen as well, the media banding around the property market is going to drop by 9% and things like that. Dav, have you seen that?
Yeah, it's it'd be as an average. It could be approximately in 9-10%. Some regions, some areas might be more. Some regions and some areas might be less. It all depends on where you're looking, how much interest that area has always had and has at the moment. Some areas will be more buoyant than others, but that's how the market has always been. It's the marketplace aligning itself, correcting itself in that regard. So it's
I think that where they get the figure 9% as well is if you look at the market over the last 20 years, if you put on average month by month, the property market's grown 0.5% every month. So if you draw that line, at the moment, after the crazy couple of years we had, we're lying 9%. The UK is lying 9% over that line. That's where they're getting that 9% figure, 9% in over the UK.
That's where the average comes from. Isn't
so that's where they're saying it's going to drop. But what people think is that it's going to slowly come back closer to that line. There's not a crash coming. There's not a crash predicted. So our opinion is don't listen to the media saying that it's a crazy drop is coming, because it's not coming. It's just slowly going to normalise.
Definitely, and don't forget, you see, start of the year, you generally see reductions in prices and things like that, and we've seen a lot of reductions in prices across the board at the start of this year. But you've got to remember that there was so many inflated prices last year because of the property boom, because of the marketplace. They've got to align themselves and come back down now. So it's not a case of the market dropping, it's just a case of the property market aligning itself and properties reducing back to a normal platform.
Yeah, so on to mortgages. So obviously Tom has just talked about, averaging within the property market. I don't really want to talk about averaging, but as you may have listened last time, we discussed how things would work in terms of how maybe people focused on the Bank of England or they focused on the media when to determine whether their rate was going to go up. Well, the main point to make on that is there are various other ways in which lenders will determine whether their rate goes up. So although we do kind of see trends, we will see trends where the Bank of England will go up, the lender will go up. We will see trends where the Bank of England goes down, the lender brings their mortgage rate down. But the most important thing to understand is that there are other ways in which lenders do actually focus on their rates changing. So that brings me on to my next point, is to do with how lenders lend to each other. Lenders don't necessarily base their rates on the Bank of England changing their rate. So the Bank of England changing their rate is all good if you're on a tracker. If you're on a tracker mortgage, if the Bank of England changes, your rate changes. And that's a good option for some, because then at least you do know when it's going to change. You know that it's X amount of points above the Bank of England. That suits you as your personal preference. And that's all down to an element of risk. If you're happy with that and you're happy to take a slight risk because it could change, but some people would argue it's not a risk because then they're not tied into a long-term fixed. What you'll find is the lenders themselves actually base their lending on something different. So it used to be things like the LIBOR rate. The LIBOR rate was the London Interbank rate, and that rate used to determine what lenders lent to each other. Now they base it on things like the SONIA rate. So that's the Sterling Overnight Interbank Average rate. And what that is what lenders lend to other financial institutions. And rates like that will help them determine whether they up their rates or down their rates. And right now, this second, as of January, we're seeing a lot of lenders lower their rates, despite the Bank of England upping their rate in December the 15th. So my whole point of all this conversation is that don't just expect things to go exactly how the media say, because often or not, there's some truth to it. But at the same time, it's the media's job to create some sort of scare.
You can't fixate on what everything is being shown and shouted out, can you?
No, exactly. And
you exaggerated every time.
Yeah, that's the word.
They will exaggerate things, and I'm sure you know that as British people. You know what the media can be like.
I'm glad, Andrew, you've gone into this, because I've got a good friend who is a journalist, and he said he listened to the first pre-podcast and he enjoyed it. He said, I'm not going to listen to it again though, because you were banging in on the mainstream media. So I'm glad we mentioned it again.
I've got to be careful.
Don't listen to the mainstream media.
Yeah, I mean, I've got to be careful what I'm saying here. Obviously I do want to see tomorrow, but at the same time, I'm not saying don't listen to the media.
I'm saying don't listen to the mainstream media.
It's not all doom and gloom though, is it?
I am impartial to all media channels. What I'm trying to get at here, without boring all our listeners to death, is that rates are not determined purely on the Bank of England. Understand that lenders will look at their own ways on how they work out which way the market's going. It'll depend on certain ways of forecasting fixed interest. That's another one. They'll look at a 2-year a 5-year and a 10-year forecast on on whether or not they lend at certain rates and so on. So just make sure, when you're, looking at this market, don't just expect it to go in one direction. Expect it to level out, expect it to average, expect it to go back up again, and then expect it to drop again. But do similar to what we've done. A lot of people, tend to just look at the current market. As Tom said, look at 18 years, look at 20 years, 30 years. These are all ways of understanding what rates do. And, it's not me giving, that's not advice, and I got to be very clear that that's not me giving you financial advice on that. That's just as a tip if you want to look at, different things and market trends and rate trends and so on. A good way, or a common way of doing it, is looking at a set period, because that's exactly what lenders do anyway. Lenders are forecasting the next 10 years, whereas you could look back at 10 years, whatever you want to do works for you. But the main thing is things can average out, and that's the end.
I was going to go in then.
As we've said in the previous podcast, there will be a quiz, and we said at the start of this podcast we give you your quiz questions, and now we'll give you our quiz answers. So I'm going to start with the property guys. What's your first two?
So the question was, and Dav gave it to us earlier, between week 1 of 2022 and week 1 of 2023, which year had a higher number of sales agreed? So Dav, give us the answer.
Okay, so week 1 of 2023, there were 9,231 sales agreed, compared to 2022, where there were only 9,161. So 2023 clinches it.
So the mental year of 2022 had less sales agreed in the first week than 2023.
Correct.
Forget everything we said earlier about the market coming down. That is quite a crazy stat, and it's shown that there's a good start to the year. We still believe everything we said earlier, but it has been a really good start to the year. I
love this one. I love this one. Number 2, to the nearest 10 million, what price was the most expensive house listed in 2023? I will be surprised, unless you've cheated and looked at this online, who got close to this.
So the highest price house listed in the UK in 2022 was priced at £200 million, and it's been described as a 45-room private palace looking over Hyde Park, and it was bought by a Chinese billionaire for over 200 million in 2020.
That's insane.
Wow.
200 million.
A lot of moolah, that.
You know what? I'm doing the figures in my head now. I would love a piece of those fees.
It's a tasty little fee. Go on then, and what is an offset mortgage?
An offset mortgage is a mortgage with a savings account attached to it, and that savings that you have can go against what you owe on a mortgage. So it's just an extra little option. If you've got a bit of money that you can put aside, that money can go against what you owe on the mortgage. And number 4 is, what is loan to value? So many people, when they put a deposit down, will know that they put, say, 10% down, 20% down. Literally, all loan to value is the other side of that. So it's what loan you owe to the property value is worth. So for example, if you own a house that's worth 100 grand and you put down 90 or 90,000, then you are loaning 90% against a 100 grand property, equals 90% loan to value.
Cheers, boy.
Thanks, Andrew. I am absolutely enthralled with that interesting information.
Do you know, this property stuff ain't too interesting either.
Okay, so
Number five.
for our out there question, I guess, the Japanese government is to offer families how much to relocate from Tokyo to less densely populated areas. We had A, 200,000 yen, B, 500,000 yen, C, 1 million yen, and D, 2 million yen.
And go on, take a guess.
Oh, I'm going to go for C. 1 million yen.
1 million yen.
1 million yen. You know what? I was thrown of 500,000
per child. It might sound 1 million yen. It sounds like a mental amount of money. It is. I say only. It's quite a lot of money. It's over £6,000 per child to relocate people in Japan out of Tokyo because it's so overly populated. That is madness.
Is there any offers for me?
Anybody paying for us to move out of Swansea?
Yeah.
So let us know how many questions you got right. If anybody got 5 out of 5, please send us a message. Andrew will tell you how to get in touch with us later.
Inquiries at.
But we have. We always said we're going to finish with a tip, and as it's our first podcast, we are going to give you 2 tips. Aren't we, Dav?
We are indeed. So,
tip of the week.
Sellers and buyers, wasn't it?
Yeah. So tip 1. If you are, we've got one for sellers, one for buyers. And we've got to be mindful of this is just our opinion and the market research we've done. We've gone quite into a bit of depth and we've told you quite a lot about it during the podcast. If you are looking to sell over the next year, you probably want to go and do it sooner rather than later because as we've mentioned, it's looking like we're going to go slowly. We're recalibrating. The market's coming slowly down. So you're likely to get the highest price, especially after the stats we've heard about with the quiz questions in week 1. It's likely that if you get things going now, you're going to get the highest price for your property. So that's tip 1. And tip 2, Dav, is one for buyers.
It is. So most people will look at the general newly listed properties. They get notifications coming through from all the different platforms out there. Newly listed. Well, guess what? Everyone looks at the newly listed stuff. Everyone is going to look at that newly listed notification that comes on your phone. Our tip is, don't always look at the newly listed. Yes, there might be some fantastic buys out there, but guess what? Everyone's going to be looking at those as well. Go back to the most reduced or longest listed property out there on those portals because they are the ones that are ready for the picking and ready for a potential negotiation sale on that one.
You can actually as well on most of the portals, Rightmove, I won't list them all, there's lots of them out there, Rightmove, Zoopla, On The Market, Prime Location. You can actually sort them, so you can sort into most reduced or sort to oldest listed property. And it's exactly how I bought my last property. I went on the oldest listed property, and these are people that are motivated. That's where you're likely to get the deal. So if you're looking at getting a property below market value, this is you must do this because it's a lot easier. It makes it a lot easier for us.
Great tip. Not everybody does it, but it's out there for everybody to use.
Yeah,
100%. Yeah, well done.
Awesome. And I hope you've all enjoyed.
Hope you've enjoyed as well.
There you are. You finish off, and
yeah. So we hope you've all enjoyed. This is the first proper property and mortgage podcast that we finished. So thank you for listening. And remember, as we've said last time, if you have any sort of topics or any questions that you have about this podcast, then email us at inquiries@thetidesaroffpodcast.co.uk or drop us a DM on Insta, LinkedIn.
Don't forget to follow us, subscribe as well.
Yep, follow, subscribe, comment. Thanks for listening, and we look forward to seeing you next time.
Yeah, thank you.